flanked by family members today. Dr. Fred Giertz is on the phone, I believe. Dr. Fred, are you on there?
I'm here.
Good.
Good to
Okay.
talk to you.
Let me get to my intro here that seemingly disappeared. I'm with certified financial planner professionals, well, both David Ruedi and Paul Ruedi, and David is also a retirement income certified professional. And with Ryan Repko, who's joining us. We kind of pulled him in today, didn't we?
He did. He was just here to set up the camera. Now he's on the spot, not knowing the notes either.
I got you on that. And I was looking for my intro notes, Paulie, but they seem to leave me. Anyway, you listen to Paul Ruedi's On the Money on WDWS, and happy to be with everybody. Remember to do your own research and due diligence. Past performance is no indication of real world results, I should say, or future results. You can call in at 356-9397, or you can text in on the text line, which is 3515357, I believe. I think I got that right. I'm doing it all from memory. See? Old Dad still has it.
I was gonna say, you know the intro down cold. You don't even need the notes.
So anyway, we have Dr. Fred up front. I'm going to go to my first line of questioning. Certainly, Fred, there's a lot of stuff going on out there. There seems to be stronger and stronger. Seems like just at a time when things are getting really good. And I read something today that showed that corporate tax receipts or tax earnings are, I think I'm looking at it right here. I know tax receipts are up 17% from a year ago. One reached a record 1.92 trillion. It sure seems like just when things are clicking pretty good for the economy, now all of a sudden, are the tariffs getting a little more concerning to you, Fred?
Well, they're always concerning, but it's more of a long-term problem, I think, than a short-term problem, because right now it's hard to tell whether the tariffs are there to stay or simply a strategic measure trying to get some kind of concessions from other countries, especially China. But again, it's worrisome in the long run. But right now it seems a kind of situation where we're moving ahead despite all the obstacles. Again, we've had kind of a mini stock market cycle in the last couple of weeks. It was down considerably a couple of weeks ago, and then the last 3 or 4 days it's been up very strongly. So the economy seems to have a kind of life of its own, and things are pretty good now. The jobs report was strong. The Federal Reserve seems to be prepared to go ahead with their modest rate increases. We've gone from a situation where we're worried about wage growth, and now in terms of it wasn't growing fast enough, and now some firms are worried about wage growth making it more difficult for them to operate. There seems to be more job slots available than almost ever, and unemployment's at a near historic low, even though it increased very slightly last month. So again, it's you can think of it as kind of a sweet spot. It's maybe not as sweet as 3 or 4% growth, but it's certainly a good situation.
Yeah. You're breaking up a little bit, but as long as it doesn't get worse, okay. I'll let you know if you need a call back.
Okay.
And it's 112 months now into this economic recovery. It's one of the I think it's the second longest, if I'm not mistaken.
Right.
So I think from that standpoint, so a lot of people think just because the economy has grown for 112 months and it's the second longest, that it's almost imminent that we end up with a recession. I always have this feeling that the economy doesn't care who's the president and doesn't mind a calendar either. Would that be safe to say?
Right.
Yeah, because
I think that's true. There's a saying that's often appropriate at this time of the cycle, and that is that expansions don't die of old age. They die of some kind of situation that brings them to an end. So just because they're old doesn't mean that they're going to end. But again, they don't last forever either. So
we've had I think since 1850 we've had a recession, at least one per decade. And of course,
right. And often in the old days like being before the 1980s, recessions occurred about every 5 to 7 years. More recently, it's been around 10-year periods. So the recessions have grown farther apart. And in addition to that, except for the big asterisk of 2007 to 2009, Most recessions have been fairly mild. That was one very big exception, though.
And one of the things that's been frustrating me, for a couple of years now, is everybody says, well, this is the 9th year of this bull market, as if we haven't had a bear market, which a bear market's defined as a 20% decline in the broad markets, whether it's U.S. or international. And I've shared this in newsletter to clients quite a while back that I don't see it that way. I look at 2016 and what went on the first 6 weeks, the worst 6 weeks in U.S. history for the stock market. But if you look at the international markets, we're down well more than 20%. Small caps, mid caps down more than 20%. So I kind of feel like this bull market, the stock market, is only a couple of years old, and that's certainly
right. They're also
contrary position.
A pretty severe decline in the last part of 2011. People were worried about the lack of a budget deal, things of that sort. I think the difference, though, which again is something I think relatively new, even when we do have these downturns, they tend to be very short. And many times the market goes down, it stays down for months, even years. More recently, it's gone down fairly rapidly, but then come back almost as rapidly. So we haven't had these long kind of discouraging periods when the market just goes down and stays down.
Is that because the Federal Reserve is getting better at what it does, or is it just no correlate or causation at all?
Well, again, over 10 years ago, I would have said that, but we used to talk about the Great Moderation when since the 1980s, the recessions have grown further apart, and they've been milder, and we hadn't had inflationary problems, things of that sort. But then we had the aberration of the 2007 to 2009 period. So again, I think that's true, but there's always the potential for some unexpected thing to happen, like the downturn of the Great Recession. Again, I don't think we have to worry about a financial crisis right now. That's not a problem. And I don't think we also are in a situation where we have a broad so-called market bubble. There may be certain areas that are a little bit frothy. But so again, I think it's fairly strong. The other thing, which we always talk about, is maybe all the good news has been incorporated into asset prices, and even if the good news continues, it may not mean that stocks are going to shoot up over the next several months.
It sure looks like earnings are forecasted to be stronger. And I, of course, I'm the incurable optimist. I always, take the feeling, because I hear so often the stock market's overvalued. I take issue with that. I mean, you want to talk about something that's overvalued, it's a 10-year treasury note at a 2.8% yield. That's a price to earnings ratio of 32 almost. So I kind of take a little bit of issue with some of that, what's going on. And I always take this position, guys, that we don't and we can't know how things are going to turn out in the future. But it's just that I remember in the 80s, nobody really was sitting around forecasting the internet issue, and all the technology boom, because you couldn't have foreseen it. And I sometimes take the view, and I'm that incurable optimist, that well, maybe the market's telling us something. Maybe there's things we just don't know what's going to develop. And maybe that's what technology is telling us again right now, because the technology sector.
Well, it's kind of almost a leap of faith, because most of us believe that there are going to be good things happening in the future, but almost no one knows what the good things are. If we knew what the good things were in the future, the new internet or the new iPhone or whatever it might be, we'd invest in it and make tons of money. But we don't know that. We have to have some sort of faith in the economy that innovation is going to continue. But the idea, though, I guess probably your sons will agree with me more maybe than you do, but the idea of overvalued or undervalued really is a very useful concept, unless you're a market timer, because you're basically saying that the market is what it is most of the time, and the idea of passive investment is to sort of go with it and not try to come down on the side of overvalued or undervalued.
I think that's spot on. And I guess I read so many negative articles that I think people do. They read about how and they've read this year after year, really since 2010 or 11 probably. And I think it does keep people on the sidelines. And you're right, we're agnostic. I may opine about the market, as I did in 2010 and 11 and 12, basically newsletters to clients saying, well, we're not changing a thing, but just so you know, I don't agree with this overvalued stuff. In fact, I think the market is so undervalued by a bizarre amount. And it turns out that turned out to be the case. But again, that's not. I wouldn't have told anybody to act on that. I think sometimes
they'd act if they were sitting on the sidelines and should have been invested. That might be the last kind of nudge to get them to move in.
Yeah, I agree. You shouldn't be in or out based on valuations. You should be in ownership of the great companies of America for one reason only. You have enough time horizon in your world, and that those returns, the potential returns, not the guaranteed returns, the potential returns are so much better than the potential bond returns over the next 5, 10, or 30 years. That's because it creates an alignment between what's the purpose of the money. Well, I want to retire in 10 years, and I'm going to be retired for 30 probably. So therefore, I need to have a significant or a reasonable portion of my money in the great companies of America in the world. Certainly, we don't have an inverted yield curve yet. The 2-year Treasury, I think, is at around 2.56% last I looked, and the 10-year Treasury is at a 2.86%. So even if it was inverted, there's time lag between inversion of that yield curve. In other words, it's saying, look, when short-term rates get higher than long-term rates, there's this kind of expectation that there's going to be this slowdown and earnings are going to go down. It's kind of one of those classic signs. But when you pierce that data, you say,
it's also maybe, in a sense, it's kind of returned to a normal situation because long-term rates have been in the current range for a while, but now the tightening of monetary policy, some of the term rates are going up. So again, there's no, even though they talk about the inverted yield curve, it's not like a magic formula to predict a recession.
No, I'm just basically saying, Fred, that even if people were right and we get to this inverted yield curve, and we may have a recession because of it, and that may or may not be true, but just from an historical standpoint, it would still be probably, based on historical time measures, it still would probably be a year or more out. And so it doesn't look like we're going to get a recession in 2018 unless, like you said, there can always be a surprising event, which is unknowable. So,
I think we may have talked about it last time, but even someone who's very circumspect, former Chairman Ben Bernanke, said he didn't expect a recession, but in any event, if one were to occur, it was going to be 18 months or so into the future. So again, there's no guarantee even from former Fed chairman, but that's sort of an indication that no one sees anything on the horizon as dampening what's happening now.
And again, that's showing up everywhere. Retail sales are strong. Housing is basically in another boom again. All these things. Unemployment, the Fed's projecting it to go to 3.6%. Inflation, pretty tame at around 2% on the core inflation. Fred, one of the questions I get a lot is, when the Fed talks about core inflation, and this comes up, from being on the show all these years, Fred. Well, excluding food and energy, the inflation was this number. And I think that really bothers people because most of us cannot exclude food or energy out of our life. But that's just because they're so volatile and there's so much noise in those two numbers that it kind of messes with the trend.
They're not saying that when they say we ignore energy and food, they're not saying that's not important for people. They're saying for their own policy purposes, they don't want to take a quick action based upon some big increase or fall in oil prices, things of that sort. So it's not that it doesn't impact consumers. It's their own way of trying to kind of modulate their own policy issues and not overreact to these kind of changes.
Do you think that maybe we've been lulled into this sense of almost pessimism from an economic standpoint? We've come off of year after year after year of somewhere around 2% real GDP. That maybe there's going to be maybe 3.5%, 4% GDP, real GDP in the future. May take people by surprise, but maybe that's what we're building in this pipeline. I'm just wondering about that with all the tax cuts and deregulation.
It would take me by surprise. I think that if someone could offer me a deal, I'd be delighted with 2.5% long-term growth rate. It's not what we had in the past, but it's better than we've had in the recent past. And there are a lot of obstacles that facing an aging population and things of that sort. So again, it's possible. I think this Right now, we may be above 3%, but I think it's unlikely we're going to be that way in the long term.
Oh,
but
no,
again,
I'm just thinking over the
habit.
I'm, of course, thinking of the next year or two or three. What is it really?
Sure.
Well, what would really surprise people? And I think if you started seeing 4% GDP numbers, and we've lived through
that
one
would
before, it'd be more typical after a really serious recession. But we're so far from that serious recession now that it kind of. Anyway, these.
Yeah, well, it should. I mean, you could argue maybe it's making up for lost time because generally a severe recession has a fairly sharp bounce back as well, and that didn't happen. So maybe what we've done is to incorporate the recovery over a longer period of time as opposed to having it fairly sharp after the downturn. But again, there's a lot of discussion in the economics area about long-term growth, and if there's a consensus, it's probably that we're not going to go back to the post-World War II 3% plus for a long period of time. But that's not to say it's going to be really bad either. So again, my deal would be sign off on 2.5% and be happy, but that deal's not really available.
And if you look at the corporate earnings, guys, since the Great Recession, we've been going to all-time highs since early in the early period post-recession. And I've always, thought to myself, wow, if these companies can make this kind of money in a really slow growth economic environment, what might they be able to earn in a 3 to 4% real GDP over the next 2 or 3 years if that comes to face? I mean, maybe that's what's bubbling up here and keeping so many people on the sidelines thinking this thing surely has to go down. But earnings from corporate America are, like I said, they're at 17% higher than they were, corporate tax receipts than they were a year ago. And those are big numbers. 17% is a huge increase.
Yeah, recessions have a way of getting people's attention. So one of the sort of positive in a strange way, but one of the positive impacts of a recession is that it causes firms to take a very hard look at their operating procedure and incorporate some efficiencies that may not have been high on the list beforehand. So recessions do have a kind of a function in terms of weeding out things and calling some of the bad operations. That may be why we had a pretty big increase in profits shortly after the recession.
Yeah. Well, it's been nothing short of amazing. I think it's, again, when you see how investors behave over the last 10 years, they've missed a huge part. And when I say that, you look at cash flows in and out of stock mutual funds and in and out of bond mutual funds. And they're not behaving as if they're behaving as if this bull market's got a long way to run in a contrary sense. In other words, when you see people just at the most brief downturn, a few weeks back, and then a little bit earlier in the year, the least little amount of pullback, you see almost record sums of money running out of stock mutual funds into bond funds. And bond funds primarily that are hurting.
It's another sign that it's not like you get a tip on the street and everyone's rushing to put money into the equity markets. Actually, money's coming out. So that's probably a sign that we're not close to the top.
Well, you've been around a long time and you've seen this and monitored this economics and stock markets longer than I have, but I've been doing it for 35 years. And I guess I was just making the observation of, boy, I can remember how people were behaving, when the market would never go down only to see it go down pretty severely. It's just a different behavior issue. And just an observation on my part that that's not how big bull markets die, is when everybody runs for the hills the first time somebody coughs. Anyway, I'm going to move to a blog that you wrote recently.
Okay, great.
You want to stay on, Fred?
I'll listen in and see. Yeah.
Okay. You're certainly welcome to add in. In fact, we're going to talk about an article that Paul wrote, I think, after this one about smart beta. And the guys were thinking, I'll be interested to hear Dr. Fred's spin on that. And because especially from your background on pension funds and currently on the SIRS board, what kind of discussions may or may not be coming around that. But that's going to be the next section here in just a little bit. But Paul, you wrote a blog, The Retirement Mountain, where you kind of liken investing and saving for retirement is like climbing to the top of a mountain. And I know you like to do. I wouldn't call you a mountain climber.
I wouldn't call myself a mountain climber.
A mountain walker.
Yep, that's more accurate.
But I know you do some pretty rigorous ones that, you get up there and you wonder how you got there. Usually I like to ask, where did you come up with the idea for that? Was that literally like where you on one of these long treks where you think,
Yeah,
like,
it was written
wow,
amongst.
You really got to be patient. And
Yeah, it was written amongst several hikes, and I like to get out to Colorado and Las Vegas and California to get out to mountains, get a little elevation. For me, growing up in the Midwest, flat ground at sea level, pretty
Orchard
much.
Downs isn't enough of a mountain.
It was a mountain to me. It still feels like
it was
in
when I
some
was
ways.
a kid.
Yeah,
in the wintertime.
and I got the same program in Texas, so I moved to an equally flat place. So hiking up.
Sure.
Hey, Fred, I think we got a little bit of noise on your end.
Okay.
So hiking up a mountain, there's nothing in my athletic vocabulary that has prepared me for that. So it's a pretty difficult challenge, but I really like being outdoors, and I take my time and I go slow. So, a lot of times on the way down, getting up to the top of a mountain is very fun, but on the way down, you're not really working towards that reward. So you kind of have a lot of time to just kind of think to yourself. And, over time, I would say maybe I would get one idea on each hike and say, hey, that's really a way that hiking like this is similar to planning for retirement.
Dave, you kind of, just as a quick aside, you're really big into nutrition and study that a lot. And, you've drawn a lot of parallels between nutrition. So sometimes it's just things that we like and enjoy bring us to some of these parallels when it comes to our own careers and investing. So anyway, I just thought I'd throw that out there.
Yeah, absolutely. And I mean, if you do your homework and you sort of work up to bigger goals, I guess, and this is the same with retirement planning,
is there like goal setting process involved in that? Is that what, like, you don't just go walk up a mountain?
There is. And I recently achieved one of my biggest hiking goals kind of unintentionally. And we'll get to that a little later, but it was a hike up to Charleston Peak, which is the highest mountain peak outside of Las Vegas. It's about an hour northwest of Las Vegas. And it's I've hiked the area before. My buddy and I like to go out there, and it's kind of been on my radar for a while. It's like this big looming mountain that's off in the distance. It's kind of this mysterious, intimidating thing.
Isn't that kind of like retirement?
I'd say that's where
there's this mysterious thing out there. And
yeah, I'd say that's where the similarities start. People who are planning for retirement are a lot like people who are sitting at the foot of the mountain looking at the top. They have this huge, intimidating thing ahead of them. They know it's going to be a lot of work. It's going to take a while, and they're probably going to have to come up with some sort of plan for getting there. So yeah, there's a lot of parallels with just the intimidation factor that you feel at the foot of the mountain, just like you feel when you're maybe my age or Dave's age starting to save for retirement.
Well, and I think that intimidation factor can prevent people from actually getting started. It's kind of like you put it in this black box and want to go into denial of like, oh no, I don't really need to be addressing this right now. You just kind of like ignore it. And really I think a lot of that does stem from fear or just overwhelm. I think it's a feeling of overwhelm.
Do you think some people when they're earlier in their career in 401ks, they figure, well, if I can't save 15%, it's saving 3% of my salary is not worth it. In other words, if I can't attack the top of the mountain, maybe you got to walk for a month and build up some endurance. Or if you're in Colorado, maybe you got to spend a few days before getting just used to the low oxygen levels.
Or quite frankly, years. I mean, I've been building up to this most recent hike for a couple years. And I guess that's one of the most important things to remember about both mountain hiking and retirement planning is you have to understand your personal situation and set reasonable goals. So for example, I have friends that live in Colorado. They live at elevation. They do 14,000 foot hikes or 14ers for, that's a little bit of hiker bro jargon for you, 14ers. And they do that stuff all the time. And I've been out, with them. We went to Aspen one time and they were going to do one of these hikes. And I just knew better. I shot for about the halfway point. There was a really cool lake. I was happy. I wasn't disappointed that I didn't make the hike with them because quite frankly, I would have got to the halfway point and I would have been shot. I mean, I would never, my legs would have been dead. I probably would have been hypoxic. And you really have to know your limits because you can go out there and have a great time basing your goals on just what works for you. But if you try to stretch for what other people have, you generally are going to get into frustration. You really shouldn't measure your retirement next to what other people have and what their goals are.
Yeah, well, that's really important because it's you think about a hike as being, well, it's not that complex, but really there's a lot that goes on to planning that, to get to preparing, to get your endurance. I can see a lot of parallels between that. And then there's probably complications that happen. You think it's going to be a smooth hike, and next thing you know, you're halfway up there and you're starting to second guess yourself. Think about how much investors second guess themselves, when it comes to retirement.
Yeah, that's exactly right. And we always emphasize the importance of a financial plan for retirement. So, of course, I had to draw a parallel there. I use an app, and it's also a website called All Trails, and I put a screenshot in the blog if people want to see it. But it tells you basically what your route is going to be. You see an aerial view of your trail route, because a lot of times there's really only one route to get there. And this is the same way with retirement planning too. There's sometimes an easier route and a harder route. And this trail map is generally going to show you the easiest, most direct route. So you really want to plan in advance, because if you just tried to walk up a mountain and tried to get there, there's no way you'd get there, right? Something would end up in your way. So it's good to have, I use my All Trails app, but in retirement, you use your financial plan to say, hey, how much, are my goals reasonable? Can I actually get there? How much legwork am I going to have to put in? And in hiking, it's how many miles am I going to have to cover? But in retirement, it's how much saving am I going to have to do? And once you kind of understand that, it makes the mountain a little less intimidating. You realize what you're getting into. And I would say even more important than that, you kind of hinted at it, is when you get off track, which you will often do. These trails are not always the most clearly marked. And you'll look at your app and you'll say, gosh, I'm like 20 or 30 yards to the right of the trail, and you know which adjustment to make to get back onto the trail. And that is exactly like a financial plan in retirement. It's not set it and forget it. Really, this is a guiding tool to help you make those adjustments, because your plan will recognize that you're off track, and here's what you got to do to get back.
And you're never going to be precision. You're never going to have precision. So it's kind of gets to that concept. I'd rather be approximately right than precisely wrong.
Right. And then even if you don't get exactly right back on the trail, even when you're off the trail, kind of which direction you should be heading. So yeah, there's been some times out there where my All Trails app has really saved me from going drastically the wrong direction.
Well, isn't that what a plan does? When we have a plan just at that time, when you get into a nasty stock market situation, or even bond market situation, or maybe it's a lot of things at once. Maybe
or something in your personal life.
Something in your personal life that rocks your world. A boulder that runs down the hill that wasn't supposed to be there. And isn't it? We were talking about this on the way here. About the guys are prolific writers. And again, I mentioned last time on the last show that Paul, my son Paul, won the was chosen as one of Investopedia's top 100 most influential advisors in the U.S.
Thankfully, they didn't rank them 1 to 100, because I have a feeling where I would have been on that.
You'd have made the other 99 possible. You'd have made the upper 99 possible, I'm sure. And so they write a lot, and these guys talk a lot about writing and how to be effective at it. I mean, if you just throw details out there, they're boring. And like, what if you tell them too much? Well, then do they need you? And I said, guys, I could tell somebody exactly how to do what we do. I could write a roadmap that was precisely right for the next 30 years. And at the end of that 30-year period, somewhere they would have gotten off the trail. They would have second-guessed themselves. They wouldn't trust their compass. They'd start going the wrong direction, and that's how people get in trouble. And so I think that's a good analogy. Dave, what's a reasonable starting point then as far as goal setting, a baseline goal?
I get this question all the time, and honestly, it's really hard to answer.
Is that mainly from your people of your age?
Yeah, mostly, because they're the ones wondering, okay, well, usually the question is, how much do I need to save? And I'm like, well, I can't answer that without a ton more information. And a lot of that is, well, what are your goals? And then I can't really tell people what their goals are, but I think a reasonable kind of like typical scenario would be retiring somewhere around age 65 and trying to replace your current net income. Now, obviously, some people are going to say, there's no way I'm going to work until 65. I want to retire at 50 or 55. Well, that's fine. It's just going to be a lot more difficult. And so that's where it gets back to, like Paul said, being deliberate, setting your goals, creating a plan, because a plan to retire at 55 is going to be drastically different than a plan to retire at 65 when you have Medicare and you don't have those additional health insurance premiums. And not only that, you have 10 years less where you're taking portfolio withdrawals. So at the end of the day, you have to choose goals that really jive with you, that you're motivated to achieve. But I do think there's, like Paul said, there's a certain amount of reality. If you start choosing goals that are way too lofty, it might lead you to do some dumb stuff, like maybe you're taking way too much risk with your investments in terms of concentrating in an individual stock, trying to shoot the lights out, or do something silly so that you can retire at age 35 because you heard about, you read the 4-Hour Work Week by Tim Ferriss and you got inspired and you felt like you didn't want to work anymore.
Well, you guys in your 20s and 30s, Ryan's crossed the 30 threshold. Paul's knocking on the door.
Thanks for reminding me.
Dave's in his upper 20s. I just wonder, when you guys are with your buddies, is there even any discussion about, I want to retire? I mean, does it even come up?
No, and even people that I've just done kind of one-off financial planning for, just because I like to help out people my own age. A lot of the times you do have to coach them on what their goals should be, because everyone wants to retire and spend $100,000 a year starting at age 40. And that's just, unless you're making $1 million right now, it's really not practical. So you sometimes have to not be the bearer of bad news, but be the bearer of realistic expectations that, like Dave said, you're probably going to start right now, at least shooting for somewhere like 65. But you may end up exceeding those goals, and we'll get to that later.
It's gonna change a lot, just like your personal tastes of what types of mountains you like to climb. Like, those are too boring for me. I got to do 14ers or whatever you crazy kids say out in Colorado.
You're picking it up, yeah.
So on top of setting expectations and having that map, I mean, that's really, if you don't do those fundamental prerequisites up front, is that, good luck retiring or having any concept of being able to retire without some type of I could substitute the word map. I could substitute plan for the word map, couldn't I?
Yeah. You absolutely could.
I mean, the same thing. If you get off course, this is where you would make the adjustment. This is how much of an adjustment to make. These are the things to watch out for. We have to plan that bad things can happen. What type of clothing are we going to bring along? In other words, we get into bad market periods and just bad periods, and you can't just say, it looks sunny and it's warm, and forget that, there's a front that could come through at any time.
I made that mistake. The forecast was 50 degrees and kind of partly cloudy, and we got up there to the last 4 miles of our hike, and it was 70 and sunny. So I don't know, hopefully you can't see it on the camera, but I'm still peeling a little bit on the backs of my arms from, I got punished by Mount Charleston a little bit on that one.
In other words, and that happens to people, right? They get complacent. It's when our investments are going up month after month in our 401k plan, we can get kind of complacent and forget. I always, for some reason, this popped into my brain. My dad, was a Chicago guy, south side of Chicago mainly. And anytime we would go up to a Cubs game in the summertime, he'd say, make sure you bring a sweatshirt or a jacket. And we're like, Dad, it's going to be, it's 88 degrees here in Champaign. Well, it can't be that much, it's got to be hot in Chicago. He says, if that lake wind shifts, you'll wish you had a jacket. And of course I ignored him one time, and all of a sudden it went from about 82 degrees to about 42 degrees and windy and kind of cold and rainy. And it was like, we were going to have to leave the game. It was just miserable. So having that map. What about the importance of doing this planning early as opposed to, hey, that looks like a nice mountain, let's go climb it?
Yeah, and if my buddy and I would have started this hike at noon, we probably wouldn't have made it. So we started at 6 a.m. to give ourselves the most time possible. You can go at a little easier pace, you can take breaks, and that same exact thing happens to retirement, except with retirement, the benefits are actually twofold. You spread out your saving over more years, and your initial savings have more years to compound. So there's even more of a benefit to starting early with retirement.
All right, we're going to go to Carl from Atwood, Illinois. I see. Carl, welcome to Paul Ruedi's.
Yeah, I'm not from Atwood, but that's where I'm at today.
Oh, okay.
Anyway, aren't you happy that you took your father's advice as a guide to get to where you're at today? There's that old saying you've heard, daily devotion is better than yearly resolution. I've been to the mountaintop. I fell all the way down to the bottom because I didn't have my ropes in place.
Yep.
And I never did that really, but I fell out of a tree once.
I understand.
I love that analogy, by the way.
Metaphorically.
Yeah. But I'm now at the bottom, retired, and I wish I had an auto. You've heard that one. Someday I'll,
yes.
All that other saying.
Yes.
Yeah, I suppose if I'd have put a nickel in the bank every day, I'd been rich, because I've got friends that, I'm not jealous of them, but they did the right thing. They set aside a little money and just refused to ever touch that. And I would say for the young people, I'm 68, so anybody that's 62 and younger, just set aside a little bit of money on a regular basis, and have somebody to guide you along the way, like the Ruedis. This isn't Paul Ruedi, is it?
Yeah, it's Paul.
The father?
Yes.
Oh, I thought it was a son.
Well, he's
you
here
have
too.
both in the room.
Both of us are here.
Too many Pauls.
Okay. Well, anyway, I'm listening to you on DWS, and but I talked to you once before, and you said you had to save $1,000 first, and that hasn't happened yet. But I am enjoying life, and I wish I had an auto, because then I would have enjoyed more, and I would have been able to give more away.
And I think, and when you're sitting there in your 20s, it's hard to recognize that, isn't it, Carl?
Yeah. So that was part of the reason I called. People that are listening, tell your kids and grandkids, you need to set aside a little bit of money so you can have more at the end.
Yeah, because
compound interest.
Yeah. And when one night you go to sleep and you're in your 30s, and you wake up and you're in your 60s, just like a blink.
I'm celebrating 50 years of class reunion at Central. So
well, good for you.
I'm here.
I had my 40th last year, Carl, so I'm chasing you.
Yeah.
Well, Carl,
I tell people I feel like I'm 19 and my skin is smooth, my hair is jet black.
Yeah.
My voice is still the same. That's the only thing that stays the same.
Well, we appreciate.
Well, thank you very much.
Thank you for calling in and sharing your story, and hopefully that helps some others. So good to talk to you, Carl. Bye bye.
Okay.
Guys, I mean, when I go to 401k plans, and someone will say, "Well, when do you think I should start saving?" It's usually one of the younger people, a new hire, and it's in a group of 50 or 100 people. And I say, I'm not going to answer that. And they'll say, well, why won't you answer that? I go, because I want somebody who's been out on this factory floor for the last 30 years to tell you when you should start and how much you should put away. And boy, the old guys and the old, the seasoned citizens, they jump right in and they just put down a lecture that I could have never given when I was your age, when I was in my 20s and 30s in this business. They just probably wouldn't respect it. But when they know the guy Joe or the lady Mary who's been out there for 42 years and is still working, maybe because they want to, but still they're going to put the smackdown on those young ones. And that really gets to the starting early. Isn't that just the most powerful dollars we ever get to invest, is the ones we invest earliest?
Yeah, absolutely. And I just think that kind of ties into even starting early on a mountain hike. Starting early actually enables you to achieve goals that you might not have, and you might even surprise yourself. So I think a lot of people probably thought that I really set out to get to Mount Charleston on this hike, but my buddy and I actually did it to get to the halfway point and do it as kind of a simulation run to see if we could get to that critical halfway point in the right amount of time to maybe try to do this hike later in the year. But what happened is we left early, we took our time, and we got to the halfway point with pretty fresh legs. And though I think once we got about 90% of the way to the top, we regretted it a little bit and took a little grit, but we got there. And I think that's the same with retirement planning. If you start early, you work on a plan, you don't shoot yourself in the foot, basically, you're probably going to exceed the goals that you started with.
And anecdotally, that I've seen that pretty commonly. We have people come into the office, the ones who have been diligent savers from the time they were young, and they just can't believe once we build a financial plan for them that a lot of times they'll come in saying, well, I want to retire in 5 years. And then we show them, well, you can retire right now and spend more than you're currently spending.
Yeah.
And they just can't believe it. But
in that, it's real. You guys hear me probably more times than you care. They'll say, well, I'd like to retire maybe in 4 or 5 years. And I can kind of skim their financials and their investments and kind of what they've done, and the critical mass. And typically, I already know the answer, and I'll say, well, are you working now because you want to, or because you think you need to, or a little of both? And they say it's a little of both generally. And that's when and sometimes on that front end of a meeting, we can say, well, if that's what you're taking home after taxes and after you put money in 401k plan, and if that runs your world, I'm guessing that it's that plus another $1,500 a month. And you could do that right now. And many times they don't go and retire just because I told them they could, financially speaking, because they're not prepared to emotionally, or they enjoy it. But one thing they all tell me, they enjoy going to work a little bit more, knowing that when they put the key in that car that day, they did it because they wanted to, not because they had to. And that's that mentality from starting early, mistake proofing it, being prepared. Don't try to do it all at once so you get burned out. Incremental is fine. Starting out with 3 or 4% in your 401k. Okay, maybe it's not ideal, but at least you get the full match. And then each year after year, you take some of your raise and you increase your deferral into your 401k contribution by 1% a year. Before you know it, you're putting 10%, and then 12, and then 15, and then next thing you know, they're saying, hey, that's all you can put in is the 18,000 or 24,000 if you're 50 years old or older. And so I thought that was a good. It was a nice article. I think there are those relationships and those similarities. It always circles back to it's in the planning. Success is always built in the planning. It's dangerous to probably go up a lot of these mountains if you just say, oh, I don't know what the trail looks like. I really don't know how high that is. It just looks high. You can really get into a lot of trouble real fast.
You can get into even more trouble going down. I think that's probably the last similarity that's worth pointing out is, when you're climbing mountains, it's riskier on the way down because if you slip up, you make a mistake, it's a lot harder to recover from it. You can just keep going because of gravity and whatnot. It's easier to make a misstep.
And your legs are toast.
when you're working and you have time to save up more money and recover from things, that's one thing. But when you actually are retired and now you don't have an income, you're not saving, you're actually withdrawing money from your investments, it's really important to get things right and to have that plan to keep you on track. Because if you get it wrong, it could mean running out of money.
What do you think keeps people from going in to see a financial advisor and kind of taking that, whether you're 20s, 30s, 50s, it's never too late. It's maybe not ideal to wait that long, but what do you suppose keeps at least half the people from having a financial plan and having a financial planner? Is that just...
Well, I think money is kind of personal. Money and health in particular, are things just people don't like to talk about, even sometimes with a professional. I think people have an easier time talking to a doctor about their illnesses than they do a financial advisor about their finances. So I think there's an emotional factor there, but I also think people are afraid to declare their ignorance of certain topics because everyone has to be...
Or maybe they're embarrassed that they made some mistakes along the way that... Welcome to the human race. I haven't seen anybody walk through my office that hasn't.
Oh, absolutely. I was talking to my Uber driver yesterday, and she was telling me all about her bankruptcy proceedings, and I could tell she was kind of sheepish about it, but I had to explain that there is nothing in our educational system that prepares you to be financially successful like that. So, yeah, it's not their fault, but for some reason they feel like it is.
Yeah, it could be. You think it's intimidating?
I think so, yeah.
The idea that I have to be vulnerable and lay out either what I have or haven't done, and maybe what I have done I don't feel great about. You guys are going to make me feel stupid, and we don't do that. I mean, I think, and I don't think it's unique to us. I'll say that almost all the advisors I know in this town are pretty good people that aren't going to embarrass you. I think you can allow yourself, in my experience, to have that vulnerability and take that first step. And I think once they get through that first step, I think. We have a low-key approach that I think really is inviting. I think that's the feedback we get, and I guess that's just our nature. Yeah, Ryan.
And I think some people will say that.
By the time you said something right.
I know. Give me a minute on the air today. Some people will say, "Oh, I'm doing just fine for myself. I do pretty good." And I think we hear that comment from people, and that's kind of just said in a vacuum. There's no measurement to it. You're not benchmarking yourself necessarily against anything. You just putting money away, and maybe it's not invested in the right place or aimed at something at a specific target date or anything.
Be pointed at something.
It's just kind of you're bobbing like a ship at sea with no direction. So giving you a little bit of direction by meeting with an advisor can point you in the right direction, hopefully get you on a right path.
Yeah, even if it's not a fit, like most of the time, a good advisor is going to say, you know what, I don't know that I can add enough value in your life. I can see that you have an acute issue here that you just kind of need to be pointed in the right direction. And I would say we do that as often as not, as we say, well, not everybody wants to hire us or needs to hire us. And so maybe they don't fit our mold, but they usually walk out with pointed at a much better attack than what they're doing, or maybe we iron out some wrinkles for them and they feel really good about that. We'll pull Dr. Fred in on this one since he's been so patient. But
I had
go ahead, Fred.
I had my own analogy that might be helpful.
Okay.
I had a friend once who ran a marathon in Antarctica. He wanted to do one on every continent. I had, what did you learn? He said, what I learned was no matter how warm you get, don't throw your gloves down. And he got cold later.
Yeah. Well, that's, I think that's that complacency, and that's that not having that rule book in front of you that says, hey, I got to throw my gloves down. I'm like, wait a minute, that's rule number 4. No matter how warm your hands are or how warm it is outside, don't throw your gloves down. It's like my dad saying, I don't care what the forecast is in Chicago for being hot and humid. I've spent too many times when that late wind turns and you're 30 or 40 degrees colder. So I think that's good. Paul, and you also wrote an article for Investopedia that was also picked up by NASDAQ on their website too, called Smart Beta Strategies for Retail Investors. It's kind of this new wave, this smart beta. You're seeing Vanguard get into it. You're seeing a lot of the exchange traded funds, the BlackRocks and the iShares, or maybe they got purchased by on these major exchange traded funds, all targeting what's called smart beta. I've always thought of it as factor investing, and I've been doing it since 1990. And you guys worked at Dimensional Fund Advisors, both of you, for several years, and that basically, I think they were kind of the pioneers of what I call factor investing, but now people call it smart beta. So I'd like you guys to talk a little about what is it, because people are seeing it. So if somebody asks you, well, Paul, or David or Ryan, what's smart beta to begin with?
I would say that smart beta is or factor investing. They're really kind of interchangeable terms. It's kind of a catch-all term for investing in specific groups of stocks with particular characteristics. Usually that characteristic is that they're going to have a higher expected return than the broad market. Not all the time. Sometimes you have low volatility and you have different, they got a whole menu of them out there now. But moral of the story is, instead of trying to pick stocks, people are now trying to reap the returns of particular asset classes because those asset classes have been shown to behave a certain way.
And why did this rise to such a prominence suddenly?
Well, I think it's really caught on because it's been very effective, and basically kind of what happened, I think it helps us to go through the history. So when you hear beta, kind of the counterpoint to that is alpha. And so historically, active mutual fund managers and professional investors said, well, I'm going to basically generate excess performance, which they called alpha, by picking stocks or timing the market. Basically one of those two things. And research came out that said basically the vast majority of them were failing miserably. And so people went to using index funds and saying, well, I'm just going to match market returns. The thing is, not a lot of people like the idea of I'm just going to own the entire market and just match market returns. They're saying, well, I want higher returns than the market. So smart beta kind of came about. Basically what they did is research came out that said, okay, well, just because you can't pick stocks or time the market doesn't mean you can't earn higher returns. There are certain groups or subsets of the stock market, groups of stocks or subsets of the market that seem to have higher returns than others. So an example would be small companies have higher expected returns than just the broad market or than large companies.
So
it kind of just snowballed from there.
It kind of started with small cap, didn't it? When Bance, wasn't that his name?
Rolf Bonds.
Did a study that said, hey, wow, now that we know the return of the broad asset class, U.S. stock market, now that we've kind of looked underneath it and ranked stocks by the biggest to the smallest, it looks like these small company stocks, at the very bottom, produce much higher returns historically than the largest stocks at the other end. And so that became a factor, right? Is that that would be a smart beta. There might be a smart beta fund that just tries to isolate the small company size premium.
Exactly.
It's not a free lunch though, right? I buy micro cap or small cap stocks. Does that mean if the premium return historically might have been 1 or 2 or so % a year more than the largest stocks? So I sign up, I buy it, I'm going to get that?
Well, usually there's some excess risk there or some reason for the premium to be there. And that kind of gets back to, and I don't know if I'm stealing Paul's thunder here.
Go ahead and steal
it. About this, but I think one of the issues you can run into when people are performing research is they're pouring through historical data, and there's tons and tons of researchers out there. And there's the issue of data mining, which is basically, in layman's terms, my explanation is if you have enough people looking at a subset of data, they're going to find some strategies that worked in that data set.
Isn't that what they say? If you torture data long enough, it will tell you anything you want it to.
Exactly. So the trick is you have to basically say, well, how confident are we that this is not a fluke, that it's not just statistical randomness, and that it will persist in the future? And so what you do, or what a lot of researchers do, is they look for things like, well, did it persist over time, or was it specific to a couple decades? Do you want to stop? And
Yeah, I'm going to take a call. We're going to take a call from Jerry. Oh, call in. Sorry, Jerry. I probably got to you. I probably didn't notice you fast enough. Okay, drop. Go ahead, Dave.
Yeah, and you can always call back. The other thing is it pervasive across markets. So does it show up in the U.S. and also international markets, or does it just show up in a specific country or a specific sector? Other things, is it cost effective to capture? There's things that will show up on paper, but when you take into consideration real world trading frictions and costs, you're not able to actually capture them in a cost effective manner.
You might spend $2 chasing $1 of premium.
So it's there, but
sense.
it costs you too much to do it. Talk about the major ones. Talk about the ones we've incorporated really since 1990 into our clients' plans. Let's go for the big ones first.
Well, what happened as people started pouring through investment returns and all the research around that, they found that there were a relative handful of factors that really drove a lot of the performance of investment portfolios. So the first one was just whether it was invested in stocks versus bonds. That was called the market premium. And beta actually arose in Bill Sharp's equation, the CAPM equation, as a way of describing how much of a security's return was based on beta.
Just for being a stock.
Just for being a stock, right. So that explained, I think, somewhere around 60 to 70% of stock returns. But then in the 1990s, Gene Fama and Ken French accounted for two different factors. One, that small company stocks have a premium over large company stocks. And then value stocks, or less excellent companies, ones with a lower relative price, have a higher expected returns than ones with higher relative prices. I'm sorry, I'm getting turned around here. And ultimately, those became your new betas, right? So now you went from one beta to three betas. You had
three
market,
factors.
You had size, and then you had value. And that actually explained 96% of stock returns. So that gave us two new factors. But it's important to remember a lot of time passed in between, decades. And then recently, we've really just seen an explosion into 5 and 6 factor models that are now accounting for momentum or trend. Basically, if a stock's going up, it tends to continue going up. They account for that. They also account for companies that have higher profitability or higher quality. So now you're getting into all these different factors, and some of them are newer than others, right? So size, value, the market premium, those have been around for decades. They've been pretty well vetted. They've been implemented in investment portfolios, but you also have newer ones that the research isn't out there. They haven't been tested, and I guess it's still a little bit of guesswork as to whether or not they're going to work
Fred,
out.
in the final couple minutes, are you seeing this? Is it even being talked about at the pension board levels type of things that you're involved in?
Yeah, it's talked about a great deal. And I pretty much agree with what you said, Paul, that it's not a free lunch. It's a way of taking slightly more risk and getting a higher expected return, but it's not a free lunch. So often it's not that it's not a good idea, but often it's sold as a riskless way of increasing your return, which really isn't necessarily true. So it's kind of a mini timid way of participating in active investment, but you're doing it in a very measured way with a lot of constraints. So again, it's a very reasonable kind of strategy, but it's not a magic strategy.
And I bet
I always ask the question. Well, could you achieve the same thing by moving along the frontier by just taking on more stock and less of the fixed income and you can get a higher return for somewhat higher risk there as well. So again, it's a good idea potentially, but it's not doesn't dominate the old strategy necessarily.
Right. Okay, thanks, Fred. Yeah, that was Dr. Fred Giertz calling in for the show. I've been here with David Ruedi, Paul Ruedi, and Ryan Repko. Thanks, guys. I thought it was a nice show today. I thought it was nice. And,
join us for
casual.
the second and fourth.
Anyway, thanks for listening. We'll be back in a couple weeks.
Join us for the second